What I'm sharing today could be the most important silver update you watch all year. The data coming out right now is unlike anything we've seen in decades, suggesting a potential structural break in precious metals markets. Here's the headline. COMEX, America's primary exchange for gold and silver futures, currently holds between 103 and 120 million ounces of registered silver available for physical delivery. Open interest stands at approximately 429 million ounces of contracts. Let me repeat that because the math is critical. They have around 110 million ounces available, but have committed to 429 million ounces in contracts. That's nearly 4 to 1, meaning 4 ounces promised for every 1 ounce sitting in the vault, ready for delivery. Before we continue, drop a comment telling me where you're watching from and what you think silver will do in the next 30 days. I read these comments and want to know what your gut is telling you right now. Also, let me be crystal clear about something. I don't sell courses, signals, mentorships, or paid memberships. This is raw analysis presenting both sides, so you can make your own informed decisions. If anyone claims to represent this channel, block them immediately. Now let's get into what's happening. Silver ETFs crashed 38% from their peak in just 7 trading sessions. The reversal came after spot silver plummeted below $65 before recovering to $77.33 on Friday. This whipsaw action reveals extreme volatility, delicate positioning, and a battle between two different realities. 3 factors converged to trigger this crash. First, CME Group raised margin requirements for gold and silver futures for the 3rd time in 2 weeks. When exchanges raise margins, leveraged traders must post more capital or close positions. Many can't, forcing them to sell, creating cascading pressure driven by market mechanics, not fundamentals. Second, hawkish Fed expectations following Kevin Warsh's nomination created uncertainty. Third, profit-taking after record highs amplified swings. When silver hit $120, optimistic positioning had already built up. When markets are stretched, even small changes trigger massive corrections. So we have the official explanation: margin hikes, Fed expectations, profit-taking, dollar strength. That's the paper market narrative. But there's another reality that tells a different story. If silver fundamentals are so weak that prices should crash 38%, why is it nearly impossible to source physical metal? If paper prices are correct, dealers should be flooded with inventory. But the opposite is happening. The gap between paper contracts and physical inventory has worsened dramatically. Multiple dealers report extreme difficulty sourcing physical silver. Some have shut down sales entirely. This happened during COVID in 2020, and it's happening again. This tells you the paper and physical markets are completely disconnected. One is wrong. The data shows the physical market is screaming that paper is mispriced. The default scenario is based on simple mathematical reality. COMEX has around 103 to 120 million ounces registered. Open interest represents about 429 million ounces. If even 25% of contract holders demanded physical delivery instead of cash settlement, the exchange runs out of silver. That's the threshold. Recent activity shows that in January 2026 alone, an unusual 40 million ounces were ordered for delivery. 40 million in a single month when total registered inventory is only around 110 million. If this pace continues or accelerates, the math becomes impossible. Some analysts warn that by March 2026, COMEX might run out of deliverable silver entirely. Clive Thompson has been particularly vocal about this timeline. Robert Kiyosaki, author of Rich Dad Poor Dad, expects silver to hit $200 per ounce in 2026. His reasoning is based on weakening fiat currency, explosive industrial demand from solar energy and artificial intelligence, and the fundamental supply deficit that has existed for years. $200 per ounce. Silver is currently around $77 after the crash. A move to 200 would represent a gain of over 150% from current levels. Even from recent highs around $120, that's a 66% increase. Is this realistic? Silver is in supply deficit. Demand exceeds mine production for several years running. Industrial demand continues growing from solar panels, electronics, electric vehicles, and AI infrastructure. Mine supply has been flat due to insufficient investment in new projects over the past decade. Investment demand remains strong. Central banks accumulate gold. Retail investors view precious metals as hedges against currency debasement. The fundamental picture supports higher prices. But what about right now? The bullish case is compelling. Physical demand is extreme. Supply is constrained. Dealers can't source metal. COMEX inventory is dangerously low. The gold-to-silver ratio suggests silver is undervalued. Central bank gold demand remains strong. Geopolitical tensions support safe haven demand. The fiat system continues deteriorating. Bill Holter argues a silver default on COMEX wouldn't be isolated. It could impact gold, credit markets, and ripple through the financial system. If America's primary commodity exchange fails to deliver, that signals problems with all paper promises. But here's the skeptical case. Traditional analysts note exchange rules prevent full collapse. COMEX contracts include force majeure and cash settlement options. If the exchange can't deliver physical metal, it can settle contracts in cash. This means a true default, where holders receive nothing, might be impossible. Contract holders demanding delivery might receive cash instead of metal. While controversial, this wouldn't necessarily trigger systemic collapse. Skeptics also note, most futures traders never take physical delivery. Most contracts close before delivery or roll to the next month. Only a small percentage result in actual delivery. While the ratio looks alarming, in practice, most contracts won't request delivery. Who's right? Honestly, I don't know, and neither does anyone else with certainty. What I can tell you is the risk is real, the numbers are real, and the physical market is behaving unusually. From a technical perspective, silver is trading within the $71 to $80 demand zone. After crashing from above $120, price found support with a hammer formation near $64, aligning with the long-term 100-day exponential moving average. A decisive move above $80 to $85 would significantly strengthen recovery prospects toward $100 to $105. Below $71, we could see deeper correction. For short-term traders, this environment demands rigorous risk management. The volatility can work in your favor or destroy your account. Position sizing matters more than ever. If you're over-leveraged, you'll be forced out at the worst time regardless of whether the long-term thesis is correct. For long-term investors, this phase is about patience and discipline rather than action. The current fall is driven by market positioning and macro adjustments, not by breakdown in the silver story. That's an important distinction. Satish Dandapati, fund manager at Kotak Mahindra AMC, said investors can consider exposure to silver ETFs with a long-term systematic approach. Short-term volatility will likely continue, but fundamentals remain intact. He cautioned that silver is highly volatile and investors should limit precious metals allocation to 15 to 20% based on risk appetite. Akshat Garg at Choice Wealth explained silver declined because it rose too fast. Optimistic positioning had built up, and when markets are stretched, small changes trigger corrections. Silver reacts more sharply than gold as a smaller, thinner market. This explains the mechanics. Thin market, stretched positioning, margin hikes forcing unwinding. But this doesn't change the long-term case. One correction doesn't change silver's relevance, but reminds investors why position sizing matters. The question many ask is whether this is a buying opportunity. I don't give specific investment advice because I don't know your situation. What I can tell you is what data suggests. Historically, when silver corrects 30% or more, it has bounced back. Every time over recent decades, severe corrections in bull markets have been followed by recoveries to new highs. The fundamentals haven't changed. Supply deficit remains. Industrial demand is growing. Physical silver is difficult to source. What changed is positioning and sentiment. Leveraged longs were flushed out. Weak hands were shaken. Margin hikes forced liquidation that clears excessive speculation. From a contrarian view, this washout often marks correction endings. When everyone who can be forced to sell has sold, who's left to push lower? The bearish case exists too. If the Fed remains hawkish, if the dollar strengthens, if margin hikes continue, we could see another leg down. Technical support at $71 needs to hold. If it breaks, the next stop could be significantly lower. If COMEX implements cash settlement when pressured, immediate price impact could be negative, even though long-term implications would be bullish. So what am I watching? First, COMEX gold prices at nearly $5,000 send a clear signal about the monetary system. When gold reaches all-time highs, silver should follow. Second, the gold-to-silver ratio averaging around 50 to 60 historically. The current ratio of 65 suggests silver is undervalued. Third, COMEX inventory trends. If registered silver declines while delivery notices stay elevated, default becomes more probable. Fourth, physical availability and whether you can buy at reasonable premiums. Fifth, premium differentials in China, India, and other markets. Elevated premiums indicate scarcity. Sixth, the dollar index as headwind or tailwind. Seventh, Fed policy signals. Eighth, geopolitical developments. What's your time frame? Are you trading daily charts or investing with a multi-year monetary system thesis? Your answer determines how you interpret this. Short-term traders face both opportunity and risk from volatility. Long-term investors might see this 38% correction as the pullback they were waiting for. Fundamentals haven't changed. The thesis remains intact. Price corrections in bull markets are normal and healthy. Many of you have accumulated precious metals for years or decades. You've seen volatility and know fundamentals eventually assert themselves. For those new to this space, volatile environments can destroy you without a plan. Don't invest more than you can afford. Don't use leverage unless you fully understand risks. Don't follow anyone blindly, including me. Do your own research. Understand both sides. Make decisions based on your own analysis. I'll never tell you silver is guaranteed to moon or going to zero. I'm here for clarity and substance rather than hype. Let me summarize. COMEX has 103 to 120 million ounces available against 429 million ounces in open interest. If 25% demand delivery, the exchange runs out. January saw 40 million ounces requested. Some analysts believe silver could hit $200 if COMEX breaks. The fundamental case supports higher prices. Skeptics point out exchange rules allow cash settlement. Most contracts never result in physical delivery. Silver ETFs crashed 38% in 7 sessions due to margin hikes, Fed expectations, and profit-taking. This was forced liquidation, not fundamental selling. Technical support at $71 to $80 is being tested. Long-term fundamentals remain intact. Supply deficit continues. Industrial demand growing. Physical silver difficult to source. Gold at all-time highs. Position sizing matters. 15 to 20% allocation to precious metals is what most advisors recommend. Staggered accumulation is preferred over lump sum buying in volatile environments. The next few weeks will tell us a lot. March 2026 is the timeline some analysts watch for potential COMEX delivery crisis. Between now and then, watch inventory levels, delivery notices, dealer availability, and premium differentials. Thank you for being here and being part of this community. We're growing because people want unfiltered analysis rather than hype. If this helped you understand what's happening in silver markets, share it with someone who needs to see it. Subscribe if you haven't already. Drop a comment telling me your outlook. Where do you think silver goes from here? $200 or another leg down first? I want to hear your analysis. Remember, investing is about logic, not emotion. Use your brain. Have a plan. Know your time frame. Position appropriately for your risk tolerance. Don't let anyone pressure you into decisions that don't make sense for your situation. The silver story is far from over. What we're witnessing could be one of the most significant developments in precious metals markets in decades. Whether that results in a surge to new highs or a painful correction before the next leg up, only time will tell. Stay sharp, watch the data, and I'll see you in the next one.